Welcome back to this discussion on accounting standards related to revenue recognition. In the previous session, we discussed about AS7, that was about the construction contracts. And we also started something on the AS9, which was about revenue recognition in respect of contracts which are other than construction contracts. So we'll do a quick recap of what we discussed in terms of AS9, and then we'll continue with our discussion. All right, so when it comes to AS9, so we talked about its applicability. So we discussed that AS9 is something which will apply to all the revenue transactions. Okay, so it's like any other contract, but that should not be the one which gets covered under AS7. Okay, so that is how it is required to be looked at always. Then we also looked at a couple of transactions in respect of which this standard should be applied, which was more about interdivisional transfers, you can say, or you can say when the transaction or the revenue is required to be looked at from the perspective of sale which is taking place within the organization. Okay, so something which we call as interbranch sales, inter-unit sales, or interdivisional sales. So we discussed that whenever it comes to the revenue recognition of an entity, so we'll look at as to whether that revenue is recognized outside the entity or not. Because if that revenue is recognized outside the entity, then we'll not be considering that. Yeah, sorry, when the revenue is recognized outside the entity, that is the only one which will be considered. The one which is recognized within the entity, that is not something which we consider. Okay, so that's why if there is an inter-branch sales, if there is an inter-unit sales, so that is something which is ignored. That is how revenue is required to be looked at. Any other points which come to your mind quickly? If you can just let me know any other points which come to your mind that we discussed. Yes, we also talked about the definition of revenue. Okay, so revenue is purely about the gross inflow of cash, receivables, or any other consideration. And in this fact, we discussed that this revenue may arise from sale of goods or from rendering of services. Now, in terms of goods, it's all about any good. So whether it is about furniture, whether it is about any sort of chemical, okay, so something which is tangible in nature. So when that gets sold, that is what you call as sale of goods. But if let's suppose services are rendered, for example, AMC services, for example, any sort of technical support, any sort of consultancy services. So that is what you call as rendering of services. In both the cases, revenue is required to be recognized on the basis of criteria which is given under AS9. All right. Now, when it comes to revenue recognition, we also discussed that the standard requires fulfillment of certain conditions. Okay, so what are those conditions? One, there should be a transfer of risk and reward. That is one. Yeah, so what do you mean by that? That only and only when the risk and reward which are attached to those goods get transferred to the buyer, that is when the revenue shall be recognized. Till the time it doesn't happen, revenue cannot be recognized. And we took one example to discuss this. The other point which is required to be looked at is in respect of collection. Standard says that there should be no uncertainty of collection. Okay, there should not be any uncertainty of collection. Now, what is this collection? Collection is in respect of the money, the consideration, which the buyer will give to the seller. Okay, so once we have these criteria fulfilled, that is when the revenue can be recognized. If these conditions are not fulfilled, so can we recognize revenue? Do we have some exceptions? Tell me quickly, over to you. Can we see some exceptions? Or do you see some exceptions wherein the revenue can be recognized if these conditions are not fulfilled? Yes, quickly, over to you. Tell me, what will you do? So can we say that some of these conditions which are given in the standard are optional in nature, or both of these are mandatory? Means till the time these conditions are not fulfilled, revenue cannot be recognized. Quickly, yeah, please confirm, everyone. Yeah. So Abhishek says it's mandatory. Yes. So do we have any exception? The answer is no. We don't have any sort of exception. Okay. But yes, of course, there are a lot of situations wherein these conditions are required to be applied. And that is something we plan to discuss during the course of our discussion today. Okay, now, in respect of services, standard talks about two criterias. Now, what are those two criterias? Standard says that in respect of services, there are two ways revenue can be recognized. One is called as percentage of completion method. POC means percentage of completion method. So can you tell me what is percentage of completion method? This is something that we have already discussed in AS7. Yes, over to you. Any thoughts from your side on AS7? The percentage of completion method. So what does it mean? What does it require? Yes, quickly, over to you. What does it mean? What does it require? Percentage of completion method. So what do you think it will require? Yes. So I got this response from Abhishek. So he says that on the basis of the services which are provided in a proportionate manner, revenue is recognized. Okay. Manish is saying we need to look at as to how much of the work is completed. So that means we'll look at the percentage of work completion, and accordingly the revenue will be recognized. Yeah. Or in other words, we can say the stage of completion. That is something we need to analyze, because depending on the stage of completion that we have, that we achieve, the revenue will be recognized. Great. So Swati is saying how much percentage is completed. Yeah. So exactly that methodology is also required to be considered under AS9. Yeah. So when it comes to revenue recognition for services, so we are not saying that there's a duplicacy. We are saying two methodology are there, and both the methodologies are, this methodology applies under AS7 as well as AS9. Now, other than that, there's also a method which is called as completed contract method. So what does it mean? It means that the revenue will be recognized only when the contract is completed. Now, a question may arise that how do we get to know whether to use percentage of completion method or completed contract method? Yeah. So now this is something which will be dependent on the terms which are attached in the contract. If the contract requires that all the services which are mentioned in the contract are completed, and that is when the buyer will accept it, that is what you call as completed contract method, or you can say that is where you will apply completed contract method. Now in that case, will not be able to recognize revenue on a proportionate basis, something that we do in case of percentage of completion method. In that case, entire revenue will have to wait till what time? Till the time contract is not completed. Okay, till the time contract is not completed. Once the contract gets completed, that is when you recognize 100% revenue. Okay, so in this case, we can just simply say that when it comes to completed contract method, 100% revenue will be recognized, or 0% till the time contract is not completed. So there's no percentage which comes in between. Yeah, something that you get to see in case of percentage of completion method, wherein you are moving from 1 to 100. Yes or no? Yeah. So that is not something you'll get to see in case of completed contract method. Now, this again, as we discussed, will have to be looked at on a case-to-case basis. We'll have to understand the terms of the contract, and accordingly, you'll have to decide as to whether the contract will fall under percentage of completion method or completed contract method. Yeah. So now we may come across different types of transactions. Some of the transactions may involve sale of goods, and some of the transactions may involve rendering of services. So, what is going to be the first point? First point will be to check whether goods are involved or services are involved. And once we understand that goods or the services which are involved, what is the second step? Second step will be to get onto these two conditions. Okay, to get onto these two conditions. And once these conditions are fulfilled, that is when you start recognizing the revenue. If the conditions are not fulfilled, then of course the revenue cannot be recognized. Okay. Now, in respect of these two things, goods or services, the criteria is something which we have just discussed. But there is something else which the standard covers, and that is also, you can say, a type of revenue for some of the entities or income for some of the entities. So let's talk about those transactions. Interest. Now, what do you mean by interest? We are talking about interest income here. Now, standard says that interest income will be recognized in proportion to the time. So what does it mean? So let's suppose entity has given a loan to a third party. Okay. And this loan is given, let's suppose, for 3 years. Let's suppose this loan is given for 3 years. 1, 2, and 3. Okay. Now, for this loan, let's suppose amount is 100. And for this loan, let's suppose the rate of interest agreed between the parties is 10%. So now in this case, what will you do? The entity which has given the loan means the lender. The lender will recognize revenue in proportion to time. In proportion to time means in the first year, on 100, revenue of 10 will be recognized. Okay, so in this case, will not wait for all the 3 years to be completed. No. So it's something which is moving in a proportionate manner. Yeah. So that is how revenue will be recognized. Yeah. So Abhishek says that in first year, rupees 10 will be recognized as revenue. Yes, that's absolutely correct. Okay. So rupees 10 will be recognized as revenue in the first year. Now, similarly, we have got certain transactions in the nature of royalty or in the nature of dividend. So let's try to understand as to how do you recognize revenue. For royalty, now royalty could be in relation to any sort of transaction. Okay. Now royalty requires revenue or royalty income to be recognized on an accrual basis. Accrual basis means as and when that is earned. So let's suppose the contract says that for sales which are achieved by the entity, let's suppose there are two parties, A and B. Okay. The contract says that B will provide 1% as royalty income to A. B will give 1% as royalty income to A. Now, where do you compute this 1%? On sales of B. Now, as and when sales will be recognized by B, royalty income will be recognized. Okay. Why? Because that is how the income of A is occurring. So on the basis of occurrence. Yeah. So that is what you call as accrual basis. Clear? Now, third transaction is in respect of dividend. Now, dividend income. So when do you recognize dividend income? When the right to receive payment is established. So that's what the standard says. Okay. So let's suppose if I'm going to receive some dividend. Okay. So the moment my right to receive that dividend income is established. So we are not saying the moment we receive, so that becomes cash basis. Okay. So we are talking about accrual basis. The moment the right to receive payment is established, that is when the entity will recognize revenue. Okay, clear on this? Everyone clear on this? Now we'll get on to some questions. Yes, in the meantime, if you have any other doubts, any other clarifications, please let me know. I'll move on to some questions now. Yes, quickly, over to you. Any questions, any doubts if you have? Quickly, huh? Any doubts, any questions? Okay, Abhishek is asking, means when dividend is declared and if someone is shareholder on the record date. Yes, you can say that. Okay, so let's suppose dividend is declared. Declared means it's not only proposed by the directors but also approved by the shareholders. And let's suppose you happen to be the shareholder. Okay, of course, on the record date. So that is when you will receive the dividend income. Means your right to receive the payment is established. Yes or no? So that is where you will recognize your dividend income. So that's how it works. Okay, great. Any other questions? Anyone else? Everyone clear on this? Yeah? Everyone quickly, are you clear on this? Okay, Shoaib is asking, sir, what is the difference between time proportionate basis and accrual basis? No difference. They are exactly same, or you can say they are aligned. Why? Because what do you mean by accrual basis? Let's try to understand. Accrual basis means as and when the transaction will occur, you will recognize. Okay. Now, if you go to this example, if let's suppose in the first year, no interest is actually received. Okay. Let's suppose interest will be received at the end of third year. Now, if you will follow cash basis, then what will you do? You will not recognize till third year. But are you doing that? No. You are recognizing interest in the first year. Why? Because that much income you have earned, your right to interest income is established. Okay, this is what you call as accrual basis. Now, the question arises that for applying this accrual basis, what do you do? What do you do? Okay, so therein you will follow the methodology that in proportion to time means once you complete 1 year, let's recognize it. Okay, yeah. So you can say it's the application of accrual method only. Understood? Yeah, clear? Okay, Manish is clear. Swati is saying computed. Shoaib, I'm hoping you're clear on this. Yeah, great. Swati is also clear and Shoaib is also clear. Yes, great. Very good. All right. So now what we will do is we'll just look at some examples. Okay, great. Malu is also clear on this. Very good. So let's look at this example. Arjun Limited sold farm equipments through its dealers. One of the conditions at the time of sale is payment of consideration in 14 days. And in the event of delay, interest is chargeable at the rate 15% per annum. Company has not realized interest from dealers in the past. Now, which is this company? Arjun Limited. So we are talking about Arjun Limited here. Okay. However, for the year ended 31st March 24, it wants to recognize. It means Arjun Limited wants to recognize interest which is due on the balances from the dealers. The amount is ascertained at 9 lakhs. So if let's suppose we talk about that interest, that will be 9 lakhs. Decide whether the income by way of interest from dealers is eligible for recognition as per AS9. I would suggest you should not look at the solution. Huh? Okay, so tell me, what are your thoughts? Should this interest be recognized or not, and why? Over to you. What do you think? How will you deal with this transaction? Tell me. How will you deal with this transaction? Yes, over to you. How will you deal with this transaction? In this case, will you recognize interest income or not? Yeah, so we are looking at it from the perspective of Arjun Limited. What should be done in this case? Should this be recognized or not? Okay, Swati says no, it should not be recognized. Malu says interest should be recognized. Okay, what about others? Quickly, huh? Yes, quickly, quickly. What do you think? Should this be recognized or not? And some of you who have answered, can you also give me the rationale? Huh? So why it should not be recognized, or why it should not be, why it should be recognized? Okay, great. Abhishek says since the company has not realized in the past, means certainty of consideration is not established. Okay, so I think you are trying to say it should not be recognized. Is it? Okay, Manish is saying it should not be recognized. So can you tell me the reason why, Manisha, why it should not be recognized? Quickly, over to you. Yes, quickly, waiting for a response. If you say it should be recognized, why? If you say, oh, okay, great, Swati has answered this. Swati is saying, sir, if it is received on a regular basis, then it's fine, it should be recognized. Shoaib says they did not realize this in the past, therefore, it should not be recognized. Okay, so now let's go back to the conditions. So, interest, you should recognize on an accrual basis. Yes or no? You should recognize on accrual basis. Manish is saying interest has not been received. Okay, great. So if you apply the accrual basis, then of course revenue interest income should be recognized. But the next important aspect is about the collection. Standard says there should not be any uncertainty of collection. Now, in this case, we don't know whether this money will be received or not. Why? Because historically, this has been there in the contract. So if you go by the contract, it was always there, but the company was never able to receive this. Yes or no? So in the past, company has never been able to collect this. Yeah. So now the question may arise that if this has not been received by the company, so do we have certainty, or should we say that uncertainty is not there? So currently, we can't say that. Okay. So that's why it's when you talk about its collectability, that is a problem. Yeah. Its collectability is a problem. So that's why it will be appropriate not to recognize it till the time the company is clear in terms of the collectability. Okay. Clear on this? Everyone? Everyone clear on this? Any questions? Any doubts? Okay, great. Abhishek is clear. I'm just hoping everyone else is clear. Yeah. All right. So now let's look at this another example. And in this example, we'll just also try to look at one more situation. Okay. With the help of this example only. Yeah. So now please go through this example. On 15th January 2024, goods worth of rupees 1,50,000 were sent on consignment basis, of which 20% of the goods unsold are lying with the consignee as on 31st March 2024. Okay, so in this case, we need to check how should this revenue be recognized. what should be the amount of revenue to be recognized. Okay, so let me just discuss this situation with you now. Goods worth of 1,50,000 were sent on consignment basis. Okay, so let's suppose on 15th of January, 1,50,000 goods have been sent on consignment basis. Okay, so let's suppose these have been sent to a dealer. So these have not been sold, these have been sent. Let's suppose A is the party who has sent this to a dealer. Okay, A has sent these goods to a dealer. Now, in case when the goods are sent on a consignment basis, there's an arrangement between the entity and the dealer. What is the arrangement? Arrangement is that the entity will receive money only if the dealer is able to sell that to the end customer. Okay, so let's suppose if there's a company and company has sent the goods to a shopkeeper. Company has sent the goods to a shopkeeper and the shopkeeper says, or let's suppose showroom says, that till the time I'm not able to sell these goods to the end customer, I'll not pay you. Okay, so let's suppose that's the understanding between company and the showroom or the shopkeeper. In such a case, what will happen? If you look at the company, can we say that its risk and rewards attached to those goods have been passed on to the shopkeeper? Tell me, can we say that? The risks and rewards attached to those goods have been passed to the shopkeeper. Abhishek says no. What about others? Can we say that? Swati says no. Manish says no. Great. That's why till the time goods are not sold to the end customer, will A in this example be able to recognize revenue for 1,50,000? The answer is no. The answer is no. So that's why 20% of the goods which are unsold, okay, to that extent, revenue should not be recognized. So what will happen? What will happen in this case? 80% goods are sold to the end customer. So that means 80% revenue can be recognized. So 80% revenue can be recognized. What about 20%? What about 20%? For the remaining 20%, can the revenue be recognized? The answer is no. The answer is no. And why no? Because in respect of this 20%, risk and reward has not been transferred to the party. Who is the party here? Dealer. Who is the party here? Dealer. Because till the time the risk and reward is not transferred to a third party, okay, till the time that is not transferred to a third party, can the revenue be recognized? The answer is no. Clear on this? Everyone clear on this? Yeah? Any questions on this? Over to you. Any questions, any doubts if you have? Yes, any questions, any doubts? No? Great. All right. So let's move further. Okay, so what we'll do is we'll just pick up some more sort of situations, huh? And that is in respect of agency relationship. So what I'll do is I'll just go to a document, okay, that is your study material, and therein I'll pick up some examples, huh? So if you want, you can just also access your study material. Otherwise, we can just look at those questions over here. Okay. So now, if you go to this example, okay, and what we'll do is we'll just pick up this example And in this example, we'll also try to understand the transaction and the concept which is involved. Please remember that this is about agency relationship. Okay. Zigato runs a phone delivery business. As per the arrangement, Zigato allows customers to order food from local restaurants and is responsible for the delivery of the food within stipulated time. Okay, something that you get to see in case of Swiggy, Zomato. During a particular year, it collects the money on orders made online as under. Okay, so for a particular year, some number is available to you. Total price for the food item was 200 lakhs. Delivery charges were 60 lakhs. GST was 40 lakhs. So the total amount which is collected was 300 lakhs. Zigato has received 300 lakhs for the above orders from the customers, and the orders were delivered to the customers in stipulated time. So if you look at the arrangement between Zigato and the customer, what is the arrangement? Zigato is supposed to get the food delivered to the customers within the stipulated time. And we are saying that this entire money, 300 lakhs, is received in respect of those contracts only, those orders only. Okay, means wherein the conditions were fully sort of completed. Okay. Now the question is, how much revenue should be recognized by restaurants and how much revenue should be recognized by Zigato for this particular year for which this financial information is available to you? Yes, over to you. Quickly. What do you think should be the amount of revenue to be recognized? Yes, quickly. Quickly, over to you. What do you think? What amount of revenue should be recognized in this example? Yes. What should be the amount of revenue which both these entities can recognize? And also let me know the reason, rationale. Okay, Swati says restaurants should recognize 200 lakhs, Zigato 60 lakhs. I think same is the response from Abhishek. What about others? What about others? Quickly. What should be the amount of revenue to be recognized by both these parties? Over to you quickly, huh? Quickly. Yes. What do you think? What should be the amount of revenue? Yes, great. Okay, so Malu is also giving the same answer. All right, so let's try to look at this. Let's try to analyze this. See, in this case, actually, if you look at the transaction, three parties are involved. Yes or no? Three parties are involved. What are those three parties? Zigato, which is the person or the party responsible for delivery of goods. Correct? Second is restaurant, which is responsible for providing the food. Third is the customer, which is responsible for making the payment for two things, food and delivery. Correct? Yeah? Okay, great. Now, in this case, as far as restaurant is concerned, I think there is no doubt as far as its revenue is concerned. Why? Because restaurant has supplied food worth of 200 lakhs. So restaurant will recognize 200 lakhs. As simple as that. Yes or no? So it will recognize 200 lakhs. The question arises in respect of Zigato. Yeah. As to what should it do? So let's try to understand this. As to what should this Zigato do? In this case, Zigato will have to understand. Zigato will have to understand whether it is acting as the agent or the principal. Why? Because if Zogato is acting as the agent, then in this case, what has happened? Zogato has just passed on the food from restaurant to the customer. Okay. So food from restaurant has come to Zogato and this has been passed on to the customer. So in this case, Zogato will recognize the charges, or you can say the commission income, which is what? 60 lakhs. But if we say no, Zogato is acting as the principal, then what will happen? Then we'll go by an understanding that because Zogato is the principal, so that's why for Zogato, there's a purchase cost. What is the purchase cost? 200 lakhs. And on this purchase, Zogato has made a sales of 200 plus 60, 260. Okay, so in this case, what will Zogato do? Recognize a purchase cost of 200 lakhs and recognize a sale consideration of 260 lakhs. In both the cases, if you look at the P&L, P&L impact is same or not? Tell me, in both the cases, is the P&L impact same or not? Tell me, in both the cases, do you find the P&L impact same? Quickly, please confirm. Swati, Abhishek, they are saying same. What about others? In both the cases, if you look at the P&L impact, is it same? Yeah, Shoaib is also saying same. Very good. But what is the change? The top line means the revenue is impacted. Okay, the classification gets changed. Yes or no? Now, the question now arises is to assess that in which case Zogato will be considered as the principal and the agent. Okay, so for this, what do we need to check? We need to check that who is carrying the inventory risk. Means tomorrow, so let's suppose tomorrow, if there's a problem with the food, the inventory, then who will bear that? Will it be the restaurant or will it be Zogato? If we say that risk is borne by the restaurants, which will happen in this case, then who is the principal? Restaurant and not Zogato. The other point is as regards the collection. Who carries the collection risk? Who carries the collection risk? Means let's suppose tomorrow if the customer doesn't make the payment, then will Zogato make the payment to the restaurant? If you say the answer is no, then effectively Zogato is acting as the agent. Understood? Zogato is acting as the agent. Okay. Yeah. So some of these factors are required to be looked at, and accordingly we need to decide whether the party is acting as the agent or the principal. Now, which party is this? In our example, it was Zogato, or you're talking about an intermediary. Okay, and this is how you need to assess. This is how you need to decide whether that party is acting as the agent or the principal. Now, depending on whether it is acting as the agent or the principal, its revenue should be recognized. Okay, I can see this response from Divyanshi. So Divyanshi is saying it's Zogato. Okay, Zogato means it's the agent. Yeah, so that's what I can understand from you. Okay, great. Any questions on this? Because I believe it's a important concept. Huh? So if you have any questions, any doubts around this, please let me know. Any questions, any doubts? Then we'll pick up one more example. Huh? Any questions, any doubts? If you have, please let me know. Everyone clear? Yeah? Tell me, everyone clear on this? Okay, great. So let's move further. I think we can just pick up this next example as well. Huh? Very small one. TripDeal is a website that allows people to book airline tickets. As a part of its business, it agrees to buy 100 tickets from an airline on a particular date and resell those tickets to customers. However, TripDeal bears the loss for any unsold tickets. Now, in this case, what is the inventory? Inventory is the ticket. Inventory is the ticket. Who is bearing this inventory risk? So let's suppose tomorrow if the tickets are not sold, who is bearing that? Airline or trip deal? Airline or trip deal? Trip deal. So that's why can we say that trip deal is acting as an agent here? Can we say that trip deal is acting as an agent here?
Yes.
Tell me. Can we say trip deal is acting as an agent? Tell me quickly. Manish says yes. Mallu says yes. Shoaib says no. What about others? Abhishek says no. Swati says no. Yes, of course, it will be no. In this case, Tripdale is not acting as the agent. Remember the situation we just discussed. Yeah? Divyanshi is saying yes. See, if you look at Tripdale, in this case, let me just go back. Huh? Let me just go back to that example. Okay, in this example, we talked about this concept. Huh? Who is the agent? Agent is the one who doesn't take up any inventory risk. But principal will take up the inventory risk. If you talk about debtor risk, agent will not take up that. Principal will do that. Principal will do that. Yes or no? So in this example, if the tickets do not get sold in future, who will bear that? Is it the airline or trip deal? Tell me, who is bearing that risk? Airline or trip deal? Trip deal. Yeah, so that's what Abhishek says. Airline or trip deal? Yeah. So therefore, will it be appropriate to say that trip deal is the agent here? Tell me. Will it be appropriate to say that trip deal is the agent? The answer is no. The answer is no. Manish says no. That's why in this case, what will be the basis of recognition of revenue for a trip deal? Will it be that of the agent or will it be that of the principal? Tell me, how should trip deal recognize revenue? Like an agent or the principal? Tell me. Divyanshi is saying no. Great. Great. So Swati is saying as a principal. Abhishek is saying as the principal. So I think one of the participant name is missing. Huh? So he is also saying it's principal. Yes or no? So in this case, trip deal will recognize revenue as the principal. Clear on this? Everyone? Yeah? Divyanshi is saying tickets ordinary course and trip deal will be recognizing revenue as the principal. Great. Any questions so far? Any questions on this? Tell me quickly. No? So let's move on to some more examples. Huh? Okay, so let's look at this example. Illustration 7. Okay. A claim lodged with the railways in March 2000 X1 for loss of goods of rupees 2 lakh had been passed for payment in March 2000 X3, and this was passed for rupees 1,50,000. No entry was passed in the books of the company when the claim was lodged. Advise P Company Limited about the treatment for the year ended 31st March X3. Means, how should this transaction be recorded by P Limited? Okay. P is one who has lodged this claim with railways sometime in X1, and the application was filed for 2 lakhs. Okay. And to the extent of 1,50,000, it's been approved during the year ended 31st March X3. So what should be the basis of recognition? So how should this be recognized? Over to you quickly. How should this be recognized by P Company Limited for the year ended 31st March X3? Tell me, what will be the base? How should this be recognized? So how should this be recognized? What will be the basis? Over to you. Yes, waiting for a response. Quickly, how should this be recognized? What will be the basis of recognition? I'm just hoping everyone is clear on the transaction. Great. Malu has answered. Malu is saying 1,50,000 should be recognized as revenue. Can you tell me why? Why not 2 lakh? And why 1,50,000? Okay, Abhishek is saying only the amount received. Okay, so if you say only the amount received, then I think amount received is zero because we don't have any information of the amount received. And are we trying to say that we should follow cash basis of accounting? Because if you say that amount received should be recognized, then we are waiting for cash to be collected. So are you going to the cash method or cash basis of recognition? Swati is saying actually received as a result of past events. 1,50,000 revenue which is actually received. Now let me just clarify once again that you are assuming 1,50,000 is received. But please remember the question says 1,50,000 has been passed for payment. Means it's been approved. It is not yet received. Okay. Accordingly, please answer this. It is not yet received. We don't have any information of receipt. It's only approved for payment. Manish says 1,50,000. Shoaib says amount of which there is no uncertainty. Okay, so that's the concept. Very good. But what should be the amount? Abhishek says 1,50,000 because for this 1,50,000 there is no uncertainty of collection. Very good. And I think same is the rationale which has been given by Divyanshi. Okay, great. So now in this example, please go back to the same concept. What is the first thing you need to consider? Accrual basis. So every time the revenue is required to be recognized, please do not forget that we need to consider accrual basis always. Okay. So many a times you come back to this understanding that till the time it is not received, will not recognize. Please remember, if you say that, then what will happen? You are moving away from accrual basis to cash basis. Is the cash basis of accounting permissible? Tell me, is the cash basis of accounting permissible to an entity? What do you think? Can an entity follow cash basis of accounting? The answer is no. So what will happen? Your answer will go wrong. Okay. So that's why do not go to cash basis of accounting as far as your language is concerned. I can understand the thought process. Yeah, but your language will convey as if you are moving to cash basis of accounting. That is something you should not do. Number one. Number two, once you are clear that accrual basis is required to be applied, what is the other thing you will check? You will check that out of this 2 lakhs, whether this has been approved. If no, then it's been 2 years. So the application was filed in March X1. So should the company recognize revenue immediately after filing the application? The answer is no. It can't do that. Why? Because just by filing an application, company may not know or company cannot be sure as regards its receipt. When is it that the company will become sure? When that application is accepted and approved. Application is accepted and approved. Okay. So in this example, 1,50,000 is something which has been approved, over which there is no uncertainty of collection. Okay. Now, in this example, there are a couple of more accounting standards which are attached. Okay, so let me just try to discuss those situations with you. One, a question may arise, okay, or a thought process could be there that this application was filed during the year ended March X1. Yes or no? So is it an error that the revenue has not been recognized so far? And if that is an error, and if we try to recognize it now, should we be calling it as prior period item? There again, we should not say that. Why? Why? Because during the year ended 31st March X1, no revenue was recognized because there was no uncertainty of collection. Sorry, because no uncertainty of collection was missing. That was missing. Okay. So now, during the year ended 31st March X3, when that uncertainty has got so that's let's suppose has gone away, so that is when you are recognizing. Okay, so that is when your conditions are getting fulfilled. So that's why we should not say that it was supposed to be recognized 2 years back and by mistake it's been left out. No, it didn't meet the criteria of revenue recognition at that point of time. It is meeting that now. We are recognizing it now, which is appropriate. That's why there's no error which is involved. Understood? There's no error which is involved. Yeah. Now, another question which gets linked to this is that, okay, fine, there's no error which is involved. That's why we'll not call it as prior period item. But even though we don't call it as a prior period item, should we not consider this as extraordinary item? There again, no. Why? Because there's nothing which is extraordinary in nature. Just because its revenue recognition criteria has got fulfilled after 2 years, should we call this as extraordinary? Should we call this as extraordinary? Is that the definition? Is that the criteria for an item to be called as extraordinary? The answer is again no. The answer is again no. Clear on this? Yeah. So that's why here again, if we go by the criteria of extraordinary, that is also not met. Okay. So very simply, what do we say? That this 1,50,000 should be recognized as revenue, and which is something in the normal course. Okay. Which is something in the normal course. All right. All right. Clear on this? Any questions, any doubts if you have? Quickly. Any questions, any doubts so far? Yes. I'm just hoping everyone is clear. Any questions, any doubts? No? Sure? Okay, Divyanshi says no. Great. All right. So let's move further. Manish is asking what is a prior period item. So see, it's the requirement of another standard, though you'll cover this in a different standard. Prior period item, you can say it's an error which has occurred in the previous years, which you will find out now and you will rectify that. That is what you call as prior period item. Means item related to prior period. Means period prior to your reporting year. Understood? Manish, clear on this? Yes? Manish, are you clear on this now? Okay, great. So let's look at this example. INR 1,20,000 worth of goods were sold on approval basis on 1st December 2023. The period of approval was 3 months, after which they will be considered as sold. Buyer sent approval for 75% goods up to 31st March 24 and up to 31st January 24, and no approval or disapproval was received for the remaining goods till 31st March 2024. Okay. Now, the question is, how will you deal with this transaction? How will you record this transaction? Over to you. Over to you. How should this transaction be recorded? Over to you. How should this transaction be recorded? Over to you. Quickly. Yes. How will you deal with this transaction? How should this transaction be recorded? Waiting for a response. Tell me. How should the revenue be recognized? Abhishek says up to 31st of January, recognize 75% revenue, and up to 31st March, recognize 100%. Yeah. Okay. What about others? What about others? Quickly. Swati, I think, has the same answer. Great. Very good. What about others? Okay, so let me just create a time chart for this and accordingly we can discuss. So on 1st of December 2023, goods were sold. Okay. And there was a condition. Buyer said that till the time I will not approve, it should not be considered as sold. Yes or no? Okay. So buyer had to approve that. So if the buyer will not approve, what will happen? Can we say that the risk and reward has got transferred to the buyer? Tell me, if the buyer doesn't approve, can we say that the risk and reward has been transferred to the buyer immediately? Tell me, what do you think? If the terms say that the buyer has to approve the goods, until the time buyer doesn't approve, will it be appropriate to say that the goods have been transferred in terms of their risk and reward to the buyer? The answer is no. Yeah, answer is no. Great. Manish says no. Therefore, in this case, can the revenue amounting to 1,20,000 be recognized on 1st of December 2023? The answer is no. But even though the buyer is required to approve the goods, there's a time limit which is attached to that. What is the time limit? 1, 2, 3. Okay. So at the end of, so this is 31st December, this is 31st January, and this is 28th of Feb. Okay. Now, after completion of 3 months, even if the buyer is not sending any approval, it will be considered to be a deemed approval. It will be considered to be a deemed approval. Why? Because it says the period of approval was of 3 months given to the buyer. Okay. And what has happened? Up to 31st of January, buyer has approved 75%. For the remaining 25%, buyer did not send any approval. So is that required? As far as this financial year is concerned, if you look at this, no. Why? Because for the remaining 25%, if the buyer has not rejected and approval is also not sent, what will happen? That will be considered to be a deemed approval. That will be considered to be a deemed approval. In which case, what will happen? In which case, this criteria of receiving the approval or no approval will go away. So that's why if you look at this year ended 31st March 2024, within this period, all the goods are either approved or they are deemed to be approved. They are either approved or deemed to be approved. So that's why during this financial year, what is the amount of revenue which should be recognized? 1,20,000. Clear on this? Everyone clear on this? I think same is the response from Divyanshi also. Okay. So I think you have just tried to break this into two parts up to the 31st of January and after 31st January, which is okay. Yeah. We are also required to consider this full financial year. Okay. Everyone clear on this? Any questions if you have? Because with this, we can conclude our discussion on revenue recognition AS9 and we'll move on to our next topic. But I can see a couple of questions coming in. So Khushi is asking, so 25% will be recognized on 28th of Feb. The answer is yes. Yes. So on this particular date, your criteria for revenue recognition is fulfilled. Okay. But we are looking at it on the basis of year. So that's why we are not really going by the dates. Yeah. But as you asked, Kushi, your question is valid. So by 28th of Feb, the revenue can be recognized. Abhishek is asking, sir, act adopting transaction means? So what do you mean by act adopting transaction? Okay, so you are talking about the solution. Huh? So it says buyer has done an act adopting the transaction or the time period. So adopting the transaction means he has approved that. So either he'll perform this act of approval, adoption, or he will perform an act of rejection. Yeah. So adopting the transaction means he has approved that, he has adopted that. Okay. Clear on this? All right. So then I think Malu has a query. He's asking, sir, in this case, 50% was approved, then what? So if let's suppose 50% was approved, say, let's suppose the timeline for 3 months was after 31st March. Okay. And up to 31st March, Malu is asking if only 50% is approved by the buyer. Then what will happen? Can you recognize the balance 50% during the current year? The answer is no. Why? Because as far as the risk and rewards are concerned, as far as the risk and rewards which are attached to this are concerned, what has happened? Those criteria is not yet fulfilled. So if the risk and reward is not transferred to the buyer, can you recognize that revenue? The answer is no. Okay, so in that case, what will happen? You will be able to recognize revenue only for the 50%. For the balance 50%, you will not be able to do that. Okay, clear on this? All right, so then I can see this query coming from Divyanshi, and I think this query is also coming from, uh, I can see one more query coming in. Just a minute. Huh? Okay, sure. Yeah, great. So I think both of them have similar query that is about sale and repurchase. I think you're talking about sale and repurchase arrangement. Yeah. All right. So see, this has been briefly captured if you look at your study material. So what I'll do is I'll not get into too much details around it. I'll just briefly try to cover this transaction. Okay. So what is a sale and repurchase arrangement? It says such arrangements are considered to be financing arrangements and no sale can be recognized. Instead, a borrowing should be recognized in the books of the seller. So let me just try to illustrate that. Huh? So I think you are more of looking at from the perspective of illustration. Yeah, so let me just go back to this example. So maybe you can just also open this example. Huh? You can go to page number 8.45. Yeah, so with the help of this example only, we'll discuss this. On 1st of January X1, KJ sells goods at an invoice value of 5 lakh to TH. So who is the seller? KJ. Who is the buyer? TH. Now this will be important. Huh? Buyer and seller. Who is the buyer? Who is the seller? Okay. At the time of sale, KJ has agreed to repurchase these goods back from TH on 31st of March at a price of 6 lakhs. So what is the transaction? What is the transaction? So there is a seller. Okay. Now seller is selling goods to buyer on a particular date. At the same time, seller is giving a commitment to the buyer that after some time, I'll buy back these goods from you. And that price is also agreed. So this transaction will be done later on, but this has been agreed now. So now we are required to record this. Okay. Now, in the books of seller, what will happen? Seller will receive 5 lakhs from the buyer. So bank will be debited. Yes or no? Bank will be debited. But the question is, can we say that sale should be recognized? The answer is no. Why? Because as far as those goods are concerned, risk and reward which is attached to those goods are concerned, can we say that has been passed on to the buyer? The answer is no. Why? Because that's a temporary transaction. That's a temporary transfer. After some time, it's been agreed immediately that goods have to come back to the seller. So that's why this money which has been received, how will the seller record this as? Like a loan, like a borrowing. Okay. Subsequently, on 31st of March, what will happen? Buyer will sell this back to the seller. Or you can say seller will buy back. Seller will buy back. Okay. Now on this particular date, when the seller will buy back, what will happen? Seller will buy that at some increased value. So let me just try to explain this transaction, the rationale which is involved. Now this is 1st of January and this is 31st of March. So we have KJ and we have TH. Yeah. So today KJ will record a loan. Why? Because KJ has received money from TH, 5 lakhs. As regards those goods are concerned, they have temporarily moved to TH and they have to come back to KJ. Yeah. So effectively, what has happened? If you look at the essence of the transaction, it's a type of lending arrangement. So today, what has happened? KJ wanted some funds, but didn't have the funds. So that's why KJ reached out to TH. KJ said, I need some funds today. Can you give me? TH said, okay, I'll give you, but in return, I want something. So KJ kind of transferred goods as a security to TH. That's how you can understand. Okay, that's the essence of the transaction. And after a certain period, what will happen? KJ will refund this money. Okay, so KJ will refund this money to TH. But will KJ return the exact amount? The answer is no, and that is also not possible. Why? Because this should carry some interest. That's why it's been agreed today itself. So KJ is saying that after 3 months, don't worry, I'll pay you 6 lakhs. Okay, so that 6 lakhs is agreed today itself. So what do you call this 1 lakh as? That is nothing but an interest cost to KJ. So how should KJ record this 1 lakh as? Interest expense. THB recorded as refund of loan. Okay, so in this case, you can very simply say that it's a kind of lending arrangement, borrowing arrangement. In which case, there is nothing as regards recognition of revenue is concerned. Though it appears to be a sale and repurchase transaction, but actually it's a lending transaction. It's a borrowing transaction. It's a borrowing arrangement. Clear on this, everyone? Yeah. Shoaib, Divyanshi, are you clear on this? Any doubts? Any questions? Divyanshi, you're clear? Shoaib, you're clear on this? Shoaib is saying yes, clear on this. I'm just hoping Divyanshi is also clear. Yeah. All right. Any more questions if you have? Because we can move on to our next standard now. Okay. So what we'll do is we'll just start with the consolidation now. Okay. Yeah. Consolidation means consolidation of the financial statements, consolidated financial statements that we prepare. Okay, so we'll move on to that topic now. But in the meantime, any questions, any doubts, if you have, please let me know. And okay, Divyanshi is also clear. Very good. All right, so just give me a minute. I'll just open the presentation for the other topic. Okay, Manish is asking, there could be questions in the exam wherein multiple layers need to be applied. See, I won't say multiple, but yes, of course, one of the examples wherein you found application of revenue prior period AS5. Okay, that was again a simplified sort of form in terms of application of various standards. That's something can always expect, and that is something very, very easy to be done. I'm just hoping. All right, any more questions? Because we are going to start with this consolidation now. Again, a very important topic as far as your course curriculum is concerned, but I would say quite simple if you understand that conceptually. Yeah? Because generally I've seen a lot of questions, a lot of queries, a lot of technicality as around consolidated financial statements. And that is primarily because of the reason that you don't get into the concept. So that's why I would request, please try to get into the concept. Don't try to mug up the things, because if you get into the concepts, you'll hopefully find this particular topic also to be quite interesting and easy. Okay. All right. So should we start with this now? Yes. Tell me quickly. All right. Great. All right. So now let's talk about consolidated financial statements. Now, as far as consolidated financial statements are concerned, there are few terms which we need to discuss before we get on to the consolidated financial statements. So let me just take you to those terms. Let's try to make ourselves familiar with those terms, and that is when we will get on to the consolidated financial statements. When it comes to consolidated financial statements, so there's a concept of holding and subsidiary, or you can say parent and subsidiary, which is required to be looked at. Okay, now what does it mean? So let's suppose there's a company A Limited. This company holds, say, 70% shares of B Limited. Okay, so B Limited has a shareholder. Who is the shareholder? A Limited. And A Limited holds majority shares of B Limited. In this case, because its majority shares are held by A Limited, and that majority is more than 50%, means at least 50% shares are held by A Limited. That's why what will happen? We can say that A has got control over B Limited. So we can say A has got control over B Limited. Now, what do you mean by control? Control means that tomorrow all the decisions in relation to B Limited, business decisions, financial decisions, okay, any other operational decisions, then who will drive that? Can you tell me who will drive that? All those things will be driven by A Limited. Yeah, A Limited. Means tomorrow A will decide as to what B can do or what B should do. That is what you call as control. That is what you call as control. Okay. So in this case, the moment we say a party has got control over another party, so what will happen? This party will be called as holding company, or you can say parent company. So this company will therefore be called as holding company or parent company. And the company which is controlled, that is what you call as subsidiary company. So this is what you call as subsidiary company. Okay. Yeah. Now, many a times you will come across this term holding, parent, subsidiary. So that's why it's very, very important for you to understand these terms. Now, further, when it comes to the control and when it comes to this getting the control, we discussed that it should be at least 50%. Okay. So if that is less than 50%, of course, control cannot be established as far as the definition of standard is concerned. So what is the standard which will apply over here? AS 21. AS 21 is the standard which will apply. Now, there are two types of situations which may arise. Say there is A Limited, which has got 70% shares of B Limited. And then A Limited is there, which has got 100% shares of C Limited. Now, in this case, can you tell me who is the holding company, parent company? Which is the parent company? Which is the parent company? Tell me quickly. A. Very good. So A is the parent. A, can we say that A has control over B? Tell me quickly. Can we say that A has control over B? Swati says yes. Can we say that A has control over C? Can we say that A has control over C? Very good. Mallu says yes. Manish says yes. Abhishek says yes. Very good. Now, in both the cases, A has got control over B as well as C. Okay. Now, because A has got control over B, so that's why what will happen? B will be called as a subsidiary of A, and C will also be called as a subsidiary of A. Okay. But if you look at C Limited, C Limited will be called as wholly owned subsidiary. C Limited will be called as wholly owned subsidiary. Means it is wholly owned by A. It is wholly owned by A. And B Limited will be called as partly owned subsidiary. B Limited will be called as partly owned subsidiary. Means it is partly owned by A. Why do you say partly owned by A? Because 30% of B Limited is owned by somebody else. Yes or no? Because 30% of B Limited is owned by somebody else. Yes or no? Is that the correct statement? Tell me quickly. 30% of B is owned by somebody else. Tell me quickly. Yes or no? Now, what is that somebody else? Let's try to understand that. When you say that A holds 70% of B, sorry, just a minute, let me just change this. When you say that A holds 70% of B, so A becomes the majority. Majority or majority shareholder. Yes or no? Now, in this case, let's suppose 30% of B is owned by, say, D Limited. In this case, what do you call as D Limited? D Limited will be called as minority shareholder. Yes or no? So, A Limited is the majority shareholder, which is also called as parent holding company. D Limited, or this remaining 30%, what do you call it as? Minority interest. Minority interest. Or you can say minority interest holder or minority. Are you clear on these terms? Yeah, so some of these terms we are going to use repeatedly. Are you clear on these terms? Yes, everyone clear? Archie is clear on this. What about others? Everyone clear? Any questions on these terms? See, so far we have just tried to make ourselves familiar with some of these terms which have been used, okay, and which we are going to apply, okay, at a lot of places. So that's why if you have any questions, any doubts around some of these terms, please let me know. Yeah, everyone clear? Okay. Now what we can do is just a minute. Let me just see if you have a query. Okay, Abhishek is also clear. Great. All right. So what we can do now is we can take a break. Okay, let's say take a break now. After the break, we'll continue our discussion, because after the break, what we'll do is we'll get on to the accounting requirements, okay, and the consolidation requirements. But before we get on to the break, if you have any questions, any doubts, please let me know quickly. Then we'll take a break. No questions? All right. So let's take a break. Yeah. So we'll meet after 10 minutes. Okay. So, and after that, we'll continue with our discussion. All right. So I think, Ashok, we can take a break now. With our discussion. Okay, so now we'll move on to the consolidation requirements. Okay, so as far as subsidiaries, whether those are wholly owned, partly owned, what is a minority, what is holding, what is parent, some of these terms I'm just hoping are clear to everyone. Now, as far as the consolidation is concerned, let's try to understand as to what's the meaning of consolidation. What do you mean by consolidation? What is required to be done in case of consolidation? Okay, so now, say for example, there are two companies. Once again, A Limited and B Limited. And say A Limited holds 90% shares. Now tell me one thing. Will A Limited be required to prepare its financial statements? Yes or no? Quickly, Will A Limited be required to prepare its financial statements? Swati says yes. Will B Limited be required to prepare its financial statements? Tell me. Yeah, Kushi says yes. Great. So now, both these entities, in any case, are required to prepare their own financial statements. B will prepare its financial statements, A will prepare its financial statements. And these financial statements, which B and A are already required to perform, what do you call that as? Standalone. Standalone financial statements. Means A will prepare financial statements of A, B will prepare financial statements of B. Now, the moment we say that A has got control over B, or the moment we say that B becomes a subsidiary of A, then what will happen? Then what will happen? A, in addition to this, please remember, in addition to this set of financial statement, will be required to prepare another set. Please remember, in addition to this, A will be required to prepare another set of financial statements. And what do you call that set of financial statement as? Consolidated. Which means that now A will have a responsibility to prepare two sets of financial statements. One that of A, second that is consolidated. Understood? Yeah. So one, the moment there is a holding company, its requirement will increase. Yeah. Now comes the question that what do you mean by this consolidated financial statements? How is it different from standalone financial statements? See, when it comes to consolidated financial statements, in this case, the information will not be limited to that of A. In the consolidated financial statements, one will have to assume as if A and B are not two separate entities. You will have to assume as if A and B is a single entity. And combine these two. Combine their balance sheet. Combine their P&L. Combine their cash flow. Combine everything which they have. And then prepare a set of financial statements by combining them. By combining them. And the set of financial statements that you prepare by combining A and B both, yeah, the resultant which you achieve, which you get, what do you call it as? That is what you call as consolidated financial statements. Now, in case of consolidated financial statements, a question may arise, what will be the components? So the components will be same. Balance sheet, yeah, statement of profit and loss, cash flow statement. Okay. notes to accounts, all of those things will remain exactly same. But because it's a consolidated version, so that's why instead of calling it as balance sheet, you will call it as consolidated balance sheet. You will call it as consolidated P&L. You will call it as consolidated cash flow. You will call it as consolidated notes to accounts. So to everything, this wording consolidated will be added. Why? Because it's the consolidated version. It's something which combines two entities. Clear on this? Clear on the meaning of consolidated financial statements, what all components are included, which entity is required to prepare, why is it required to prepare? Yeah, everyone clear on this? Any questions, any doubts so far? Quickly, everyone clear? Shoaib says yes, it's clear. I understand Archie is also clear on this. Great. Manish is clear. Great. All right. So now, moving further. Now we discussed that as far as A Limited is concerned, consolidation is something which is required to be done. Means A will have to prepare two sets. Or in other words, we can say holding company will be required to prepare consolidated financial statements. Correct? Yes or no? There's an exception to this rule. We'll get on to that exception. Now, where does this consolidation requirement comes from? It comes from the Companies Act. So Companies Act says that consolidation is something which is mandatory. AS 21 doesn't say when the consolidated financial statements are required to be prepared. It comes from the requirements of Companies Act. Now the question may arise that if AS 21 doesn't say, then where does this AS 21 come into the picture? AS 21 comes into the picture the moment you have consolidation requirement. Why? Because the moment A will be required to prepare consolidated financial statements, then how those financial statements will be prepared is something which is available under AS 21. Means consolidated financial statements, whether those are required to be prepared or not, that is not something which AS 21 will tell you. Okay, that is something you'll have to assess from anything other than AS 21. But once this applicability is there of consolidated financial statements, that is when you will go to AS 20. Clear on this? Yeah. Now, in continuation to this requirement of consolidated financial statements, we'll look at one situation which is an exemption. Exemption means even though if a company is a holding company, means it has got a subsidiary, still it may be exempt from preparing consolidated financial statements. Now, please remember, it's an exemption. It may be exempt. Means if these criteria that we are going to discuss now are fulfilled, then the holding company will get a choice. What will be the choice? If it wants to continue preparing the consolidated financial statements, it can do that. But if it doesn't want to prepare, it will be okay. Okay. So now let's look at the exemption. So what does this exemption say? So it says a company is not required to prepare consolidated financial statements if it meets all the following conditions. What is the first condition? Company is a wholly owned subsidiary or a partially owned subsidiary of another company, and its members have been intimated in writing, for which proof of delivery of such intimation is available with the company. Do not object to company not presenting consolidated financial statements. It is a company whose securities are not listed nor in the process of getting listed. Yeah. Its ultimate or intermediate holding company files financial statements which are consolidated in accordance with the requirements of this standard. So, what does it mean? So, let's try to look at this with the help of an example again. Now, let's suppose we have A Limited owns 100% shares of B Limited owns 100% shares of C Limited holds 100% shares of D Limited. Okay, it could be less than 100%, but I'm just for the timing as an example keeping 100%. Now tell me one thing, will A be required to prepare consolidated financial statements? Quickly, huh? Everyone. Will A be required to prepare consolidated financial statements? Abhishek says yes. Will B be required to prepare consolidated financial statements? Will B be required to prepare consolidated financial statements? Great. Malu says yes. Will C be required to prepare consolidated financial statements? Will C be required? Swati says yes. Great. Now, in this case, for D, which company is the holding company? C. For D, C is holding. For C, B is holding and A is also holding. For C, I'm talking about C. Huh? So let's try to analyze it from the perspective of C. For C, A Limited will be called as ultimate holding company. And B Limited will be called as intermediate holding company. Yeah. C has got two holding companies. One is intermediate, one is ultimate. Now, we are trying to check that can C get an exemption from preparing consolidated financial statements. So this requirement says if C has any intermediate or ultimate holding company and they are okay if C doesn't prepare consolidated financial statements, C should not be listed nor in the process of getting listed, and either A or B are preparing consolidated financial statements in requirements with the accounting standard. If all of these criteria are fulfilled, then what can happen? C may get an exemption. Then C may get an exemption. Then C will get an exemption. What do you mean by exemption? That if C wants, it may not prepare consolidated financial statements. But the point is that tomorrow, if C decides to prepare, can it do that? Yes, because it's an optional exemption. It's not something which becomes mandatory that C cannot prepare. Okay. So C will therefore get an option of whether to prepare or not prepare this. Clear? Clear on this, everyone? Yeah. Now moving further. There is another type of subsidiary which comes from AS21. Which comes from AS21. Standard says that such type of subsidiaries are not required to be consolidated. Now, what are those? Wherein the control is intended to be temporary. Why? Because those subsidiaries are acquired and held exclusively. Why? For subsequent disposal in the near future. Or if there is a subsidiary under which, in respect of which, there are severe long-term restrictions which significantly impair its ability to transfer funds to the parent. So if holding company has got any of these types of subsidiaries, then such subsidiaries are not required to be consolidated. Okay, yeah. So you can say this is another type of exemption which is available. Yeah. Then Abhishek has a question. Abhishek is asking, is that exemption available in that example, A, B, C, D, to B also? Yes, B can also avail similar type of exemption, provided B also meets all those criteria. Clear, Abhishek? Yeah? Clear on this, Abhishek? Quickly, yeah? Everyone, quickly, please confirm. Are you clear on this? Any questions, any doubts if you have? Tell me quickly. Yeah, so I think we have just talked about the consolidated components. Huh? So what are going to be the components of a consolidated financial statements? Okay, great. Abhishek, Swati, they are clear. Great. All right, so let's move further. Now what we will do is we will get on to the consolidation. So now we'll get on to the principles of consolidation. Okay. So what does the principle of consolidation mean? So now we'll get on to each and every aspect. Means if you will prepare consolidated financial statements, what all steps are required to be followed. So what I'll do is all of these steps, I'll just break that on a part by part basis. Okay. We'll pick up one part, we'll discuss some examples around it. We'll pick up another part, discuss some examples around it. That is how we'll approach our consolidation. We'll not prepare the consolidated balance sheet or a P&L straight away. We'll first of all look at all the exemptions, all the adjustments, all the sort of, transactions, or you can say eliminations, etc., which are required to be dealt with one by one. Okay, separately. Once we are through with everything, that is when we'll get on to the consolidated balance sheet as well. Okay. Now, whenever we prepare consolidated financial statements, what is the first thing that we discussed? We should have a subsidiary wherein we should have control. Yes or no? Tell me. We should have a subsidiary wherein we have a control. Yeah. So control is mandatory, because without control, we cannot get on to the consolidation. Okay. Therefore, on the date when the control is acquired, or you can say on the date when the subsidiary is acquired, or on the date when the investment in a subsidiary becomes that of a subsidiary, standard says you are required to compute if there is any goodwill or capital reserve. You are required to compute, you are required to check if there is any goodwill or capital reserve. Now, what do you mean by this? What do you mean by checking whether there is any goodwill or capital reserve? So let's try to understand that. Say, for example, A Limited has acquired B Limited. Okay. In fact, what we can do is we can just get onto an Excel working here. All right. So let's suppose A Limited has acquired B Limited. Okay. And say A Limited has acquired 100% shares of B Limited for the time being. Let's suppose it's 100%. And for acquiring B Limited, A Limited has paid, say, 10 lakhs. Now, this payment which A Limited will make will be to shareholders of B Limited, Because if A will buy shares of B Limited, that is how A will get control over B Limited. Yes or no? So that means A will pay purchase consideration. A will pay purchase consideration. Yeah, let's suppose that is 1,000. For the time being, let's suppose that is 1,000. Okay. Now, against this purchase consideration, what will happen? A will get business of B, or you can say A will get B. Yeah. So when B is bought, so actually, what is it that A will become entitled to? A will get entitled to net assets of B. Yes or no? So why will A make the payment of 1,000? Because A will get all the assets, all the liabilities of B. Yes or no? Yes or no? That is what you call as net assets. So let's suppose net assets of B were 700. So what's the value of net assets of B? 700. Okay. Now, in this case, for getting net assets worth of 700, for getting net assets worth of 700, A has paid in excess. Yeah. So this is the excess payment. Yes or no? A has paid in excess or not? Tell me. A has paid in excess. Yeah. Okay. Now, similarly, there could be another situation. It may happen that A has acquired assets worth of 1200. A has acquired assets worth of 1200, for which A has paid only 1000. That is again possible. Yes or no? That is again possible. Yeah. So you can say in the first option, in this option number one, or let me just call it as situation A1. In this situation number one, purchase consideration was in excess of net assets acquired. Yeah. This excess is what you call as goodwill. This is what you call as goodwill. And if you have a reverse situation means if the payment is short as compared to the net assets acquired, or you can say net assets acquired are in excess of purchase consideration, then this short amount, what do you call it as? Then instead of goodwill, you call it as capital reserve. You will call it as capital reserve. Clear? This is what you call as capital reserve. Now the question arises that why is this required to be done? What is the purpose of getting into this calculation of purchase consideration, goodwill, or capital reserve? See, because when we will prepare consolidated financial statements, when we get on to the consolidation, in the consolidated financial statements, this goodwill or capital reserve is also required to be recorded. Understood? In a particular situation, either a goodwill can arise or capital reserve can arise. Yes or no? Do you think both of them can arise in a particular situation? Tell me. Do you think both of them can arise in a particular situation? Swati says no. What about others? Do you think both of them can rise? Kushi says no. Why? Because they are mutually exclusive. Only one of that can arise. Correct? Now, the other question is that when do you calculate this? When do you compute this? This is required to be computed at the time of acquisition of subsidiary. Yeah. At the time of acquisition of subsidiary, if let's suppose A has acquired 100% shares of B Limited, say on 23rd of November 2024. Then for the financial year 24-25, consolidated financial statements will be prepared. In this case, what will happen? In this case, for the financial year, in this case, for the financial year 24-25, means for the financial year ended 31st March 25, financial statements will be prepared. Means consolidated financial statements will be prepared starting from 23rd November 2024. Now, please remember, can we prepare the consolidated financial statement starting from 1st April 2024? The answer is no. Why? Because they will start from the date of acquisition of subsidiary. Now you may be thinking, but that will not be a full year. That is okay. That is okay. Okay. And on this particular date, what will you do? You will be required to compute two things. First thing will be the computation of goodwill or capital reserve. The other one is minority interest, which we'll pick up slightly later. Okay, so this is something which you will be required to compute. Okay, everyone clear on this? Yeah, everyone clear? Any questions, any doubts if you have? Everyone clear? Any questions, any doubts if you have, please let me know. Yes, quickly, waiting for a response. Any questions, any doubts if you have, please let me know. No, so everyone is clear. Great. All right. So this was about calculation of goodwill or capital reserve. Okay. And please remember that was a very, very simple situation. So we are just trying to look at the underlying concept over here. Now, on 23rd November 2024, other than this goodwill or capital reserve, we are also required to compute amount of minority interest. Yeah, minority interest, you remember we discussed? Yeah. Can you tell me that in this particular example, wherein we have A Limited and B Limited, what will be the amount of minority interest? Quickly, what will be the amount of minority interest? Great. I think it's a very, very simple question. Swati says 0, Abhishek says nil. Very good. Why? Because there's no minority interest. When will a minority interest arise? Khushi says nil, because in this case, shareholding which A has acquired is 100%. So there's no scope of minority interest. Yeah. So minority interest will only arise when the shareholding of holding company will be less than 100%. Will be less than 100%. Okay. Yeah. Now, let's suppose shareholding of holding company is less than 100% and minority exists. Let's suppose there's a minority which exists. Now the question arises that how do we compute that minority? Okay, and what will be the basis for computation of that minority interest? Now in this case, minority interest means that portion of net assets of the subsidiary which belong to other than holding company, which belongs to that of other than the holding company. So if we go back to our example, in the same example, if we look at If let's suppose we say that A had acquired, let's suppose 80%. If let's suppose A had acquired 80%. Okay. Now, in respect of the net assets, now what will happen? Will this 100% amount belong to A? Tell me. Will this 100% amount belong to A? Tell me. Abhishek says no. So only the 80% of these two amounts will belong to A. And the balance 20% will belong to whom? Minority. Yeah. So minority computation very simply means what? That on this particular day, you will also find out what is the portion which belongs to minority. And what is that? Very simply, a proportion of the net assets. So 20% of net assets of B is what is the amount of minority. As simple as that. Okay. So now for this, what we will do is we'll look at one example. So I'll just take you to your study material, and in the study material, we'll pick up one example. Okay. Simple one again, but let's try to look at that example. Okay, so you can go to page number 10.25. Example 4, right? So in this example, what we will do is we'll just try to compute the amount of minority. We'll just try to look at this concept over there. Following information is given as at 31st March 2000 X1. There are two companies, P and S. Please remember P is holding, S is subsidiary. For both the companies, their balance sheet information is available. For P, tangible assets, S, tangible assets. P has got investment in subsidiary 1000. Net current assets of both are given. Then their share capital are given. Reserves are given. Okay. P Limited acquired 80% shares of S Limited on 31st March X1. Means on the date when this balance sheet is given, yeah, this information is available. So P acquired 80% shares of S. In the given case, if you look at P acquired 80% shares of S by paying 1000. Okay. Now, in the given case, 20% is something which belongs to minority shareholders. 20% belongs to the minority shareholders. Okay. Now, in this case, what we will do is, first of all, we'll get on to the calculation of goodwill or capital reserve. So how do we do that? We'll have to compute the amount of net assets of S Limited. Yes or no? So if you look at the question, what are the net assets of S Limited? Tangible assets, net current assets, both are 500 each. Both are 500 each. So what we will do is we'll pick up 80% of that. 80% of that. Yeah. So this becomes 800. From this, we will reduce the liabilities if there are any. If there are any. Yeah. So do we have any liability? No. So the net assets for the purposes of majority is 800. And what is the amount which majority has invested in A S Limited against 80%? 1000. 1000. Correct? So therefore, in this case, should we be getting goodwill or capital reserve? Tell me. Should we be getting goodwill or capital reserve? Tell me. In this situation, do we get goodwill or capital reserve? Swati says goodwill. Why goodwill? Because payment is made in excess of net assets acquired. 1000 is paid against 800. So excess amount goes to goodwill. Okay. Now, what will be the amount of minority interest in this? Over to you quickly. In this case, what will be the amount of minority interest? Over to you. Tell me quickly, what will be the amount of minority interest? Swati says 200. Very simple. Why? Because if the net assets were 1000, 80% went to majority. 20% belongs to whom? Minority. So therefore, amount of minority in this example will be what? Amount of interest of minority in this example will be what? Very simple. That will be 200. 20% of the net assets. 20% of the net assets. Clear on this? Yeah? Okay. Now, sometimes what may happen is, so let's try to look at one example. And with the help of this example, we'll just try to understand the situation. Sometimes when a subsidiary is acquired, what can happen? Subsidiary, or you can say the shareholders of subsidiary and the holding company may agree that the net assets of subsidiary will not be passed on at book values. See, currently all of these examples that we have discussed, in all of these examples, net assets of subsidiary were passed on to the holding company at book values. Yes or no? Tell me. Yes or no? In all of these examples, net assets were acquired, were passed on, were agreed at the book values. Yeah? At times, it may happen that it's agreed between the parties that the net assets or some of the net assets of the subsidiary will be revalued at the time of acquisition. Means all the assets will not be moved at book values. Some of assets will have to be fair valued, will have to be revalued. Now in that case, please remember, the revalued amount of the assets of the subsidiary is not recorded in the books of subsidiary. Let's suppose subsidiary has got PP worth of rupees 1000 and it's been agreed that when A will acquire, so A will acquire this PP for 12. Now, if you look at the books of subsidiary, at what value this PP will be appearing? At what value this PP will be appearing? Tell me. At what value will you see this PP in the books of subsidiary? Will it be the revalued amount or the book value? Will it be 1200 or 1000? Kushi says book value. Yeah. But for the purposes of consolidation, can you take that at book value? No. Only for the purposes of consolidation. Therefore, what you will be required to do is you will have to capture that revalued amount as well. And please remember that revalued amount will not be recorded in the books of subsidiary. No. Subsidiary will continue to have that assets in its books at book value. That revalued amount will only go and sit in the consolidated financial statements. Okay. So that revaluation is only and only for the purposes of consolidated financial statements. Okay. So what we will do is, with the help of some examples, we'll try to get onto this concept now. Okay. Yeah. So let's look at this example number 5. H acquires 70% shares of S on 1st January X1. Yeah. On that date, paid up capital of S was 10,000 equity shares of rupees 10 each. Accumulated balance of reserve was 1 lakh. H paid 1,60,000 to acquire 70% shares in S. Assets of S Limited were revalued on 1st January and there was a revaluation loss of 20,000. The book value of shares of S Limited is calculated as shown below. So let's get into this calculation. Yeah. Now, for the purposes of calculation of goodwill and capital reserve, please remember, why are we getting into this calculation? For calculating goodwill or capital reserve. Okay. First of all, we want the net assets at the book values. What is the net assets in terms of their book values? Very simply, total of equity plus reserve, that is equivalent to the net assets. In this case, the value of assets are not given to us. So how do you get on to the value of net assets? Tell me, how do you get on to the value of net assets? By taking the total of equity, share capital and reserves? Yes or no? So if you take the total of equity, share capital and reserves, you will reach the value of net assets. Correct? Yeah? Great. So 70,000 plus 70,000. Okay. Why did we pick 70,000 and 70,000? Because total capital was 1 lakh. Total reserve was 1 lakh. But is that entire amount belonging to the majority? No. Only 70% belongs to the majority. Okay. And on these net assets, there is a revaluation loss. So 1,40,000 will be the value on which revaluation loss will arise. So what will become the revalued amount? 1,26,000. What will become the revalued amount? 1,26,000. Okay. Now, against this revalued net assets, what is the amount of purchase consideration which H Limited has paid? Can you tell me? What is the amount of purchase consideration which H Limited has paid? What is the amount? Great. Kushi says 1,60,000. So now, is this amount paid in excess? Is this amount paid in excess? Yes or no? Has this been paid in excess? Great. Yeah. Swati says yes. Abhishek says yes. So that's why what do we get? Goodwill or capital reserve? Goodwill. So in this case, we'll get a goodwill of 34,000. And please remember, for calculating this goodwill, we have considered revalued amounts. We have not considered book values. If you consider book value, what will happen? If you consider book value, what will happen? Your goodwill will go wrong. Yeah, your total computation will go wrong. Clear on this? Everyone clear on this? So this is an adjustment which you will be required to make. Yeah. So similar to this revaluation gain, sorry, loss, there could also be a revaluation gain. Yes or no? Yeah. Any questions on this? Over to you. Any questions if you have? Similar to this revaluation loss, there could also be a revaluation gain. Any questions, any doubts if you have so far? Tell me. No? All right, great. So let's pick up one more example. Huh? Okay. So this is another example wherein we'll just look into some adjustments related to revaluation only. Yeah. So this is example number 7. So if you want to refer the study material, of course, you can just refer the study material also. Yeah, whichever way you feel comfortable. Okay. H Limited acquired 16,000 equity shares of rupees 10 each in S Limited on 1st October 2000 X1 for 3,06,800. Profit and loss account of S Limited showed a balance of 10,000 on 1st April X1. Plant and machinery of S Limited, which stood in the books at rupees 1,50,000 on 1st April X1, was considered worth 1,80,000 on the date of acquisition. Can you tell me the date of acquisition, please? Quickly, over to you. What is the date of acquisition? What is the date of acquisition? Over to you. Great. Kushi says 1st October. Yes. So now on this particular date, what is required to be done? Can you tell me on this particular date, what is required to be done? What is it that you will have to compute? Over to you quickly. What will you compute? Abhishek says cost of control. Yeah, goodwill or capital reserve. Correct. So can you please get onto this computation on your own quickly? Yeah, so I'll also solve this. But if you can get on to calculation of goodwill or capital reserve over here, whatever be the case, huh? And let me know your answer. Great. Okay, Archie says 1st of October. Yes, great. Very good. So I would suggest if you can just get on to the calculation of goodwill or capital reserve. Yeah, I'll also solve this alongside, but you can just solve this on your own and let me know your answer once you are done. Information of the two companies as at 31st March X2 is given. Now in this case, there are three problems. One, some sort of revaluation had taken place on 1st April. After 6 months, there is an acquisition, okay, for which balance sheet information, numbers information is not available. After 6 months, balance sheet has been prepared, which is made available. Okay. So now for the purposes of calculation of goodwill or capital reserve, what do you need? Net assets as at 1st October X1. But do you have that information available? No. So therefore you will have to compute that. You will have to compute that. In some of the examples that we had discussed so far, in all of those examples, this data was readily available to you. But is that readily available now? No. You will have to compute that. Okay. So now, share capital, general reserve, profit and loss. So again, it's a reserve. Current liabilities, land and building, plant and machinery, investments by H in S, current assets. Okay, so all of this information is available to you. Then it says H Limited, H Limited has got 80% shares, minority has got 20% shares, of course. Yeah. Then it says impact of revaluation. Yeah, so this is the computation that we are required. So if you look at the plant and machinery on 1st April X1, what was the value? 1,50,000. We are looking at the book values. And if you look at the value of plant and machinery on 31st March X1, what is that? 1,35,000. So that means there is a depreciation of 15,000. See, in this case, we don't know the useful life or the depreciation rate. Yeah. So we have just tried to compute that. So we can say 10% is the depreciation rate. Now, why is that required? Where is that required? We'll see that. 10% is the depreciation rate. Okay. Now, book value of plant and machinery as at 1st October 2000 X1 after 6 months. We need to compute that or not? Yeah. So what will that be? From 1,50,000, reduce the proportionate depreciation. So it will become 1,42,500. Okay. On this particular date, revaluation is required to be done. Yeah. On this particular date, revaluation is required to be done. Why? Because on this plant and machinery, it's been told that for the purposes of acquisition, this will be considered worth of 1,80,000. Means plant and machinery which has a carrying value of 1,42,500 and not 150. Why? Because 150 was there at the beginning of the year. But this acquisition has taken place on 1st October, on which date its book value, its carrying value has reduced because of depreciation. Yeah, it should be considered worth of 1,80,000. So what does it mean? There's a revaluation gain. So there's a revaluation gain, no problem. Now this revaluation gain will be shared amongst two parties. One, that is H Limited majority, 80%, and 20% will go to minority. 20% will go to minority. Yeah. So one portion goes to this, one portion goes to this. Correct? Okay. Now, please remember that if you look at the books of S Limited, in the books, depreciation is currently being charged at book values. No impact of this revaluation has been taken. But if you record the plant and machinery in the consolidated financial statements at revalued amount, then for this revalued amount, you will have to recalculate the depreciation. Yes or no? Yeah. So what is going to be the additional depreciation? On 1,50,000, 10% depreciation will be charged for 6 months. And on 1,80,000, 10% depreciation charge should be charged starting from 1st October to 31st of March. Yeah. So this should be a total depreciation. From this, what do? Reduce the depreciation which is appearing. 15,000, we computed that. So the balance amount means this is the additional depreciation which you need to adjust. This is the additional depreciation which you need to adjust. Okay. And this additional depreciation, where will this be passed on to? This will again go to two parties. One is H, means 80%, and one is minority, 20%. Okay. So this is how these amounts will get adjusted. These will get attributed. Okay. So at times when you have a revaluation, all of these adjustments you will have to consider. Now please remember, we have just looked at the principle of revaluation. Now you may have a question that once we get on to the balance sheet, how all of these numbers will be placed in the balance sheet. So that is going to be consequential. Once we move further, we'll look at some more adjustments. Okay, all of these adjustments eventually will start passing in the balance sheet also. As of now, we are just taking it on a piecemeal basis. So we are picking up the concept, discussing the example. Yeah. So any questions, any doubts that you have so far, please let me know, because I think it's about time and I'll not want to stretch it too much. Yeah. So any questions, any doubts, if you have, please let me know. We can discuss your questions, your doubts, and then we can just close our discussion. Quickly, over to you. Any questions, any doubts? Everyone? And my request is that in the next session, please make sure that you revise all of these points that we have discussed today. Yeah, because we are going to continue on consolidation, and it will be very, very important that you revise all of these things. Because if we meet that day and you don't revise, so you'll forget some of these points. So eventually the connectivity will be lost. Yeah, so that's why it's very, very important. Okay. So any questions? No? Everyone is clear on this? Any questions? Everyone clear? Okay, great. Manish says yes, clear on this. Swati is clear, great. All right. So I think if you're clear, then I think we can just close our discussion for today. Yeah, thanks once again, everyone, for your time and for the wonderful participation you have shown today. Thanks so much. Huh? So we'll meet next. We'll continue on this. And once again, please remember you need to revise this before we meet next. Okay. Thanks so much. Ashok, we can close.